Hello traders, Gary Wagner here. It is 9 o'clock in Honolulu, 3 o'clock in New York on Friday. Happy Aloha Friday, as we say on the islands. It is the 31st day of October, 2025, and this is the evening report for gold and silver, our weekend review. Even though gold closed higher now for the third consecutive month in a row, it did close lower on the day, as well as the second week of consecutive market declines. Currently, we have gold at $4,012 after sustaining a moderate drawdown today of $26.40. With trading open for approximately an hour and a half before gold closes for the weekend, reopens on Sunday morning here in Hawaii as well as the mainland, it is down $23.40 or 0.58%, taking an ounce to $4,014.40. Silver is trading lower by about 33 cents or 0.67% to $48.55. For the third consecutive day, the dollar has moved higher with gains today of 0.24%, taking the index to 99.819, certainly adding to the downside pressure in both gold and silver. The correction that began after gold hit an all-time record high just shy of $4,400 per ounce continued this week with only one green candle or close above its opening price this week. You can see that on Monday, gold sold off significantly in the triple digits with smaller declines on Tuesday, Wednesday, and a strong move up yesterday. That was not to be followed by another green candle today, which has us question whether or not this current correction is over. In terms of the price decline, since hitting the price apex back in the middle of October, it has moved back above the 38.2 fib retracement that occurs at 39.97. Any one of the following levels, a 38.2, 50%, or Fibonacci 61.8% retracement would be acceptable. A 61.8% retracement would be a deep correction as opposed to the shallow correction that we are currently witnessing, but both would be acceptable to continue to view this market in a full bullish demeanor. Gold did break through the simple 20-day moving average on Monday, but has maintained its price point above the longer-term 50-day simple moving average since August 26. The simple 50-day moving average is a key average that market technicians use to determine whether or not a stock or commodity, in this case gold, is in a bullish demeanor by trading above the 50-day moving average or a bearish demeanor by having its price below it. We can see that during periods of consolidation or price action that is severely range-bound, it will tend to oscillate above and below, and most importantly, the distances between the 50-day and the 20-day are very tight. During a strong price increase, as we witness from August to October in gold, you will see these two moving averages, the 20-day and the 50-day, have a larger price differential between them. You can see that they widen. The other thing that we use in conjunction to determine market momentum is by converting our standard candlestick chart into a Heikin Ashi or Japanese average chart, as I've just done. The Heikin Ashi chart literally smooths the chart out, in which you'll have long periods of green candles or red candles. What we look for in this type of candlestick chart is having no lower wick. That's extremely important. And the second thing is body size. In conclusion, I believe that gold will remain in a fully bullish posture, even though we are currently in a correction. The important thing that we want to answer as quickly as we can with evidence is whether or not the correction from the long rally beginning at 33.51 to above 43.90 has concluded. It has come down over 38%, not as steep as a 50% correction, both acceptable levels of correction, but whether or not the conclusion to the correction is over is yet to be determined. This has been Gary Wagner wishing you, as always, good trading. We will talk to you tomorrow for the next daily update and review. Bye-bye.